initially the topic of this panel is effectively finance in the absence of subsidy. I mean, that is a question we'll tackle briefly, but then I want to very much get into the discussion of the changing landscape of project finance and debt in the current market. I think the grid parity piece we're a little further away from. So if I can just introduce the panel, we have Daniel Egley, who's a VP with HSH Nordbank. We've got Sue Milton, who's Senior Director of Energy with Barclays. And then we have our token lawyer on the panel, who probably knows more than all of us put together, is Mark Wesker, partner in Osborne Clarke. So first of all, and I myself, David Maguire, I'm a founder director of B Energy Renewables, a development company. So first of all, what I'd like to do is just invite everybody to briefly introduce themselves in terms of their background and what space they're currently in terms of funding and transactions with solar. So if I could start with you, Daniel.
Yeah. I run a project finance team at HSH Nordbank, which is a German Landesbank. We run a team of about 25 people doing project finance on solar and wind exclusively throughout Europe. We are trying to do about $1 billion of business every year. Current portfolio is about at $4 billion, roughly half PV, half wind.
Thanks very much, Sue.
And just to set the record straight, it's actually Royal Bank of Scotland, not Barclays.
My apologies.
Not at all, not at all. So yes, Sue Milton, I have responsibility for the Power Project Finance department within Royal Bank of Scotland. I've been working in this area for well over 20 years now and have, and the mandate is across both thermal and renewables. We have historically been very active in Europe and indeed the UK, but in the last 5 years our focus has been predominantly UK. And solar certainly was a mandate that we actually went with alacrity back in 2011. If you'd said to me 10 years ago that I'd be doing solar in the UK, I'd have laughed actually. But it's been a very profitable area for us, and we've worked with some really interesting developers. Some of course are in the room here today. Our focus, however, going forward will be solar to the extent that there's solar over the next few years, and hopefully there will be, wind, onshore, offshore, biomass, and some limited thermal as well. Interesting enough, for those who might think this might be interesting, we're doing some anaerobic digestion work as well, which is a new thing for the UK.
Morning, my name is Mark Wesker. I'm a partner at Osborne Clarke. So I work with Alan John, who spoke earlier. It was very kind of David suggests I might know more than everyone else, but I, by background, I'm a corporate lawyer rather than a project finance lawyer, and I've been doing a lot of financing work for renewables projects generally. And the reason why I'm here as a corporate lawyer, and one of the reasons why I've been doing this type of work, kind of reflects, I think, part of the discussion which we'll have today, which is that the landscape for financing is changing. Banks aren't necessarily the sort of go-to source of funding, especially for long-term funding. There are lots of other sources, pension funds, listed bonds, retail offerings, whether it's crowdfunding or mini bonds or whatever. And we've been doing a lot of work in that space, as well as the traditional finance. So I think that's where we come into it, and I think there's a sort of whole sort of change in the market there.
Thanks for that, Mark. And I think that certainly says it to a certain degree. I think there's been challenges in this industry right across Europe, not just the UK, but certainly on the debt side and the more traditional sort of plain vanilla project finance, we've seen a period where that, quite frankly, due to liquidity and financial crisis, wasn't really available on reasonable terms. So before we kind of get into the meat of that piece of the discussion in terms of where project finance and senior debt is now, in terms of funding, in a market that's not subsidised or solar without subsidy, this whole grid parity issue, I think we're a lot further away from grid parity than sort of some commentators would lead us to believe. I think fundamentally all forms of energy are subsidised. I think nuclear being a perfect example of quite a significant subsidy. So with that in mind, just in terms of answering the first headline question that's been put to the panel, in terms of where the panel sees when the figures will add up for the banks in a market without subsidy. Daniel, would you like to comment on that initially?
I think it could potentially add up when you look at private off-takers, sort of replacing some capacity which they currently take from somewhere else. We haven't seen it yet. We haven't looked at any corporate risks that would actually stand up for 10 or 15 years or whatever tenor you need. For the next few years, I don't necessarily see that as a working structure.
Sue, would you like to?
So now I would concur with that. I think, looking at the UK specifically, with the radiation levels that we've got, I don't think that's a feasible perspective. In other countries, that might be more realistic. Ultimately, over time, panel prices coming down, efficiencies of scale, etc., that might be the holy grail that we're all aiming for, but not yet today.
Mark, anything to add?
Well, I think what I would do is actually sort of look at the market from the other end, in the sense that, as I see it, the major driver of the competitive landscape at the moment for financing isn't really the sort of revenue flows into the projects themselves. It's really the more macroeconomic conditions, because fundamentally this is a market. It's a market for funding. So there's a sort of supply side in terms of what the supply of finance is. And at the moment, you've got extremely low yield rates, which mean that there's a lot of long-term finance which is looking for a home. So pension funds in particular, for example, want to invest in long-term assets with very stable, predictable, essentially government-backed revenue streams. And I think in that context, it's not necessarily a question of looking at the the individual projects and what the economics of that might be. It's really the competitive landscape there from the other side.
Sure. I think sort of our experience has been we are in a number of markets. So BNRG Renewables has been active not just in Europe, while that remains our core market. We are developing projects in Latin America and Africa. And there we have a wonderful opportunity because we're not relying on subsidy. We just want a stable regulatory framework that allows us to connect to the grid and get a fair market price for the power that we produce. So really, in those territories, it's a function of solar resource, the bankability of the off-taker, cost of power, and the cost of funds. We tick all the first three boxes. The cost of funds bit, obviously, in these emerging territories, due to country risk and off-taker bankability, is actually precluding us from constructing out a lot of these sites. Projects. We're almost getting there, but it's going to take some time. So we're here in the UK, we have a cost of power that's significantly lower than some of those other territories. We have a solar resource that's significantly lower. We have probably very sound bankable off-takers, but unfortunately, the cost of funds is where it needs to be. We just don't have the solar resource or the cost of power where it needs to be. So I think we're a few years off from really getting to grips with this, this topic and actually seeing movement on it within Europe. So what do we have today? Well, we have, in terms of the subsidy that's there, I mean, in the UK, we've got three different types of subsidies, really, that solar are benefiting from: feed-in tariff, the ORO, and CFDs. It's been an interesting 12 months, with changes. We've got a new government coming down the line, so we'll see. I think we probably have a brief period of stability with what we have, if it can be called stability. But with that in mind, I think the industry has achieved a certain amount of maturity here in the UK. We've seen the cost of funds come down significantly year on year. I think we've seen the banks come back out and engage and provide project finance on reasonably competitive terms. They haven't been able to do that for some while. But in the meantime, what's changed for them is that in the absence of sort of banks being active in the sector for a period, we have yield investors and pension funds providing sort of unlevered, 100% equity or even their own debt product into the sector. So sort of with that backdrop, I'd like to sort of put it to the panel and Daniel and Sue in particular, is to what changes they have seen in the last 2 years and where they see themselves now in terms of providing project finance into the market. So Sue, if I could lead with you on this one.
Sure. Well, I certainly concur with your initial comments regarding the cost of debt coming down for project finance, and particularly for solar. I think solar is perceived in the project finance marketplace as being, the lowest risk of the technologies that we look at. So, with the liquidity constraints that we saw post the economic crisis, indeed, pricing was high. Now, when I look at the pricing for particularly post-constructed solar projects, then certainly across the power spectrum, it is the lowest priced debt that's available. As you rightly said, what we're also seeing now is banks coming back into the marketplace over the last 2 to 3 years. But in conjunction with that, we see institutional investors, of course, looking at this space. Institutional investors have been a bit wary of power. But solar is a really good starting point for them, particularly post-completion of construction. So we see now competitive tension between the banks and the institutional investors in terms of providing long-term debt, particularly for post-completed projects.
Thank you for that, Sue. Dana, would you like to? What's your experience been?
Yeah, there has been an emergence of new investors. Some of them are in competition with us. Some of them are clients of us, since they effectively provide funding or we just pass on the debt. It depends a bit on their structuring capabilities and willingness. On the other hand, we've seen the emergence of all equity investors. What we're currently seeing, especially in Europe, is that because debt is getting very cheap, that the returns for the all equity investors are not there anymore unless they're tax driven. That's something that remains to be seen. Apart from that, the landscape has become a lot more aggressive on structure, on pricing. I think there may be some room on the downward side, but I would guess that the journey is not going to go down forever.
Okay. I think I'll come back to the point that you made on pricing there and competitiveness, because I think a number of people in the room would like to hear what both yourself and Sue in particular have to say on that point. But before I do, Mark, can you give us a little insight to what you're seeing in terms of the competition for the debt providers in the current market?
Yes, I think there are three main areas I think I just wanted to comment on. I mean, the first we've all alluded to is institutional investors, particularly pension funds. Now, going back a couple of years ago, they were very much dipping their toes into the market. They are now, properly in the market in a big way. They are more confident in doing deals. A couple of years ago, they would have wanted a highly structured, ideally a listed bond, so that they had regulatory capital advantages. They don't now see the need for that by and large. You get more traditional monoline type financing arrangements, not dissimilar from what you'd have with a bank. So that means that they can effectively lend on smaller projects because the cost of doing the deals has fallen. So that's the first area, I think, where there's a lot of competition, and that's not going to change, I don't think, until the macroeconomic conditions have changed so that the interest rates rise, and that might link up with actually the parity point, in a few years' time. The second area where we see a lot of activity, not so much relevant at the moment to large-scale solar, but it is becoming relevant and will become more relevant, is the retail-focused products, particularly where there's some kind of community element to it, where that makes those types of financing more popular. So whether it be a mini bond or it be the crowdfunding platform, and Louise from Abundance is here on the next panel, those are increasingly being relevant to the large-scale solar, and the size of deals that's being done is increasing every month. And I think just the third point I'd say, it's not necessarily a competitive tension, and it might be something that we should talk to Stuart and Daniel about, is we're not just necessarily talking about the long-term refinancing of stabilised, accredited platforms. The area where it's probably more relevant for banks at the moment, as I see it, is construction and construction to bridge to long-term debt. And so we're seeing a lot of activity in the market where you've got some of the participants coming in and providing different types of facility that could take you through different life stages of the project.
I think that's very interesting. I think from our perspective as a developer and a sponsor of a lot of these projects, we've kind of changed our approach to business with that in mind, in that, you know, there are lots of sources of construction funding out there. It's a combination of vendor finance, it's sort of construction funding from some of the investment banks, but it's getting cheaper as the market gets more comfortable with construction risk and solar. So I guess where I see the opportunity from my company's perspective in terms of the senior debt or the project finance element is that bridging finance piece. So is bringing in a bank to provide 70-80% of my capex for a period of 3 years maybe, where I can warehouse those assets and then go to market to refinance, whether that's capital markets, bonds, whatever. So for me as a business, that's what I'm attracted to, because I'm not able to go to some of those institutional investors to fund the construction piece. They want those assets when they have passed sort of final acceptance certificate or FAC. So I need to hold those assets myself for a period of 2 or 3 years till I can get to a certain quantum size. And I think that portfolio of projects, I think there's a real good fit for a good banking partner in that mix. And that's how we've changed the structure of our business, rather than going, you know, we've got sort of the IPO there, the markets that are currently out there are quite happy with unlevered, even the large infrastructure funds like BlackRock, etc. It's all unlevered, I guess, IRRs they're seeking, so they don't want anybody ranking ahead of them. But sort of in 3 years' time, I think we can then access with those assets a much cheaper source of funds. So I'm very interested in what the banks have to say to me about my 3-year bridging finance. So with that in mind, Sue and Daniel, what are you going to do for me? So are you open to, in terms of the traditional sort of project finance structure, you know, can I refinance or exit that project finance? Can it be a 3-year term? Tell me what you guys can offer that.
Well, I mean, for us, this certainly hits our sweet spot, actually. You know, bridge financing into the capital markets, or potentially, you know, longer-term bank debt as well, is definitely something that we have been structuring in recent times and continue to do so. The issue for me for construction, we've got no problem with financing construction on solar projects. The issue really is the rock cliff. Mm-hmm. So up to what point will you finance before the rock cliff looms? You know, because the banks are looking at downside risk protection. They view that as an equity risk. So the issue for you guys is having a sufficient cushion of time so the banks and the technical advisors can feel comfortable that that project would be completed within that timeline, you know, with a bit of contingency built in, with appropriate contingency built in. However, with that aside, warehousing of portfolios of solar projects is something that we are really focusing upon at this moment in time. We've had a lot of interest in the marketplace for this. And we are certainly speaking to rating agencies, whether or not the project is rated or not, to understand the dynamics around that as well. There's a lot of interest in the capital markets, institutional investors, etc. Some might do it on more on a straightforward loan basis rather than a bond, which is what you mentioned. But certainly we are quite agnostic in terms of where the refinancing might come from. The important thing, however, from your perspective, is to structure a transaction which, you know, which makes sense for the exit, effectively. So I think that's one of the key, you know, if you like, negotiation pieces that you need to consider in terms of, you know, is this, are you locking us in for 20 years, or are you locking us in for, let's say, you know, 3 to 4 years, to enable us then to have flexibility in terms of a refinancing option once the portfolio is de-risked?
Okay.
Yeah.
I think ideally, you know, I'd like to secure banking on a kind of 15-year term, but I'm not going to be penalised then if I exit a large portion or all of that facility after 3 years, ultimately. I do take your point in terms of the biggest risk in funding construction. I think we'll all in this room have had sort of, you know, there's a vast sort of wealth of experience out there in terms of construction of solar and the rollout. I mean, when I talk to my US colleagues, they simply do not believe that we can roll out 1.5 megawatts a week or 2 megawatts a week. You know, they're on a time frame of a kind of a month a megawatt. So there isn't, I don't feel, a construction risk. It's a connection risk. So it's that rock cliff or that fit digression cliff. I think that is the big fear any investor that's funding construction in solar should have, is that connection risk. The other point that, and I absolutely concur with that, the other sort of point you raised in terms of rating agencies, and I think this is very interesting. So if you look at sort of the funds that S&P have rated in the last few years, in terms of when we look at the I think it's 5 or 6 wind funds that they've rated, and 2 solar funds in the US. And of the 5 wind funds, 4 have underperformed, and the 2 solar funds have outperformed. So I think the rating agencies really like this asset class, and I think what they're saying, or the message has been, that if you are seeking a rating for your fund and you're funding wind assets, you should put some solar in the mix to offset that variability of revenue, and it's going to help. It's not going to damage your rating, it may help it, and that obviously has a big effect on the cost of funds. But sort of Daniel, picking up on that piece as well in terms of
interesting point. We just recently had a look at our portfolio, and surprisingly almost all PV parks hit their P50s and above, whilst in the last 4 years we've hardly seen any wind farms that hit P50. Obviously the volatility in wind is much higher, but that's just one thing. If we talk to our back office or asset management, they will tell you, give me PV any day of the week. Wind, not so much. It's a lot more work. From our side, we have a slightly different approach. We're much more traditional, long-term funding people. So construction risk with an appropriate technical due diligence in PV, there's very little. It's not something that is high on the, it needs to be gone through, it needs to be worked at, looked at, etc. And also suppliers need to be top tier. We will not go to second and third tier. Apart from that, we were happy to lock in construction plus 15 years. Other countries more. That's something that the market is currently pushing as well. I think in the current interest rate environment, there's very little cost attached to actually breaking that after 2 or 3 years. Just when it comes to portfolios of smaller deals, I think there's one point which is consistently missed, and it's the actual costs of doing a deal needs to be looked at. Standardization is very important, like legal fees, DD fees. If you look at small transactions, they are very expensive. We haggle a long time about every basis point here and there, but if you then look at the cost of that, that's actually a very significant point. And by doing structures where you either standardize that or just roll the same structure over and over, I think you can do a lot for your general cost of funds when you actually look at it as a whole.
I think that's a really important point, and I think certainly project finance is expensive. The transaction cost is expensive. When you look at the legal fees, the due diligence fees, etc. I mean, there is a good reason for that. There's very little default in project finance. It's because we spend so much trying to get it right. You know, on that though, in particular, I guess Daniel, you've done a lot of deals as a Landesbank with KfW, export finance, etc. So there is a source of cheap debt there, certainly that is tried and tested. But sort of in terms of the transaction cost and the cost of project finance, so where has that gone? So can you give us a feel in terms of your terms, in terms of the arrangement fees, in terms of the basis points, in terms of margin, etc. While the standardization works and a cookie cutter approach is great, I think everybody in the room would like to know what's it going to cost me. So Sue, could I ask you maybe to lead on that, and then we'll put Daniel under pressure if that's okay. Sue from Royal Bank of Scotland, that is.
Thank you. Well, I'm just going to make a generic statement about pricing here, as you'd expect, and it's very project specific as well. You know, the structure of the transaction, the tenor of the deal, etc. But what I'd say for, you know, traditional, in the UK, for traditional long-term financing for solar projects, you're looking at possibly sub 2 for a good deal, possibly a little bit above if the developer isn't quite so well known. So that's the margin over LIBOR, and then again a generic statement, you know, arrangement fees of anything between about 1.5 and 1.9%. Again, depending on the complexity of the project and the amount of due diligence that's perceived to be required to be undertaken. Importantly, and picking up really on Daniel's point, of course, you know, the whole, if you think about the feed-in tariff regime in the UK, it was actually promulgated on small-scale projects, effectively. So, we developed our expertise in doing lots of small granular projects, which ultimately came together in a portfolio. But that's intensely time-consuming because you've got separate SPVs with separate DD to be done against it. So I think that needs to be factored in the context of arrangement fees and margins as well. So that might actually calibrate that a little bit as well. So, Daniel's in a wonderful position with the KfW, behind him. But that being said, there is competition on the long-term debt side from the Japanese banks and other German banks as well. So I think that generic flavour of pricing is what I'm seeing in the UK. Now, I'm not saying that our Royal Bank of Scotland is there. I'm saying that for long-term debt, that's for shorter-term debt, then the pricing might be fine-tuned a little bit. But again, it's a function of understanding what structuring work is going to be required to get that project away.
So just on that, and so you've given us a feel there. I think, yes, Daniel has a kind of competitive advantage with that KfW export finance money. But I think you've got a great track record in the UK, and you're probably more flexible. But on that note, in terms of quantum, where's the sweet spot for you? I mean, this has always been, is it worth your while for a capex of 5 million? Not sure if it is. Where do we need to be in terms of quantum to make it stack up?
I think that's a very valid point to raise, and that's been an issue that we've had for a couple of decades, basically, in the whole project finance arena. It sounds terribly supercilious of us to say, we can't do anything less than, but it really is generally the issues that we have in terms of resources, in terms of where we sit within the bank. So at the moment, I'm saying around 25 million would be a minimum debt size I could possibly look at. Okay. As a rule of thumb.
Sure. In terms of it starts making sense at that size for you, and you take up and sit up and take notice, it's a worthwhile deal. Daniel, where do you sit in terms of cost of finance, cost of funds, typical terms, tenor, and quantum?
Long-term tenor is not an issue. I think margins, that's market. I would say they've dropped probably between 7 and 100 basis points over the last 2 years. I would expect, or I fear, they're going to go down further. We seem to sort of lag the infrastructure world by about a year, and there you see still margins that are going down and structures that are getting more aggressive. So where it's going to all bottom out, who knows? But I definitely see the margins or continued pressure on margins. In terms of ticket size, we're looking at sort of 20 million plus. But there's a difference if you look at 5 SPVs, 7 sites for 20 million, or if you look at one project. Unfortunately, the large projects that are nice, and they're very competitive, and there's not a lot of them. So it's difficult. Same also goes for rooftop. We haven't come across the holy grail of financing rooftop. Maybe you guys have. It's a very difficult thing to do on a project finance basis. I think different structures are more appropriate for that.
Okay, thank you for that. I think the rooftop market is very challenging, particularly in the UK. There are legal complexities there that make it difficult. I think Mark kind of touched on sort of the new financing that's out there in terms of crowdfunding, and also, I guess, government from a policy perspective is pushing community projects, and that is going to require some clever financing where you have, a 5 megawatt developer owned project and a 5 megawatt community owned project, and we're seeking bank debt on both, but yet you've got one that's maybe of the same O&M contractor but very different owners, so that's going to be quite challenging as well. So Mark, rather than have you come in terms of what the banks are going to charge us, I would like to sort of field some questions from the floor. So does anybody have, I'm just aware of time here, so please, if you could identify yourself first of all, and then...
I'll just shout. Anthony Agnew from the Efficient Energy Code. Just asking about loan-to-value ratios for
longer-term construction finance, and where you see that going in the market now. So how much might be needed for, let's say, a portfolio of 20 million? What equity might be needed to get that construction finance in, and where you see that sort of size going up and down in the market?
So debt equity ratio, effectively.
Exactly.
Daniel.
What's the underlying fit? What's the underlying fit? Are we talking rocks? Are we talking CFD? Are we talking fit?
If we assume 4 or 5 megawatt projects, so feed-in tariff.
Feed-in tariff. then it depends very much what your capex is. It depends where the developer wants to cash out. Somewhere between 60-40, 80-20, I would say.
Okay, if it was a long-term hold, for example.
Yeah, without looking at the I mean, you really, it's an impossible question to answer, to be honest.
More in terms of where you see the market going and where you feel it might be now. A very generalistic statement as opposed to any particular project.
I think for inverted commas cheap projects where there's not a lot of developer margin in it, you see fairly high gearings. And I also expect that with everybody getting more comfortable with the asset class, for gearings to go higher. I mean, you've seen it in wind where people are doing 90-10 these days without blinking. So PV is going to go the same way. I know we've done in the past, we've done German PV at 95.5. It's an issue of getting comfortable with it and project cost to be appropriate and then irradiation to be good.
So
So historically in the solar space in Europe, certainly 85-15 was not unusual. I don't think it's an issue around long-term debt, which actually drives the gearing level. Touching upon what Daniel said, it really is the underlying revenue stream and the cost base of the transaction. So I think that there's appetite out there certainly to go up to potentially 85-15. But if you look, let's say, to a ROC regime rather than a feed-in tariff regime, you're unlikely to get much more than 70-ish type percent just because of the stress testing you have to do around the merchant element of the ROC PPA. With the feed-in tariff, you're more likely to get a higher level. But even so, we haven't really seen, generically speaking, debt levels much. 80% would be doing quite well, actually, in the context of feed-in tariff in the UK. That doesn't mean to say there's not the appetite to go a bit higher, but you just need to actually justify it through your stress testing and your revenue and the assurance of your revenue that's coming through. Now, CFD might be quite an interesting debate, because there, of course, you've got a quasi-feed-in tariff, a bit more like the EEG regime that they've got in Germany. So that theoretically could actually push the gearing up a little bit more than that.
So I guess in response, you've got a wide range there in terms of debt equity ratio on projects, but ultimately, I think when you look at FIT, RO and CFDs, I think CFDs is probably going to sort of allow you to gear up a little bit more and FIT versus the RO, where you've got a bigger proportion that's merchant risk in there. Any other questions from the floor? Tom.
In your area, are you able to say to potential investors, look, we don't suffer from this risk, so money ought to be coming our way? I mean, is that genuinely happening, or is it just a dream of those in renewable energy?
Actually, Mark, maybe if you'd like to handle that.
Well, I mean, we see much more in the renewable space generally than in the the dirty industries, as it were. But certainly from our perspective and looking at the market as a whole, there still looks to be financing going on in the traditional industries. That it's a very different market and with very different players in it, because with the best will in the world, the scale of those types of transactions are completely different. So you've got different participants chasing different bits of the market. So frankly, I'm not necessarily convinced the two are linked.
Sue, Daniel, would you like to comment and add to that?
I would agree. I don't think that, I think that, the renewable budget is big, and for the right deals, we're available to finance them. Thermal generation is something, I wouldn't mind having a little bit more thermal generation just to diversify the portfolio a little bit, because in the last 5 years in the UK it's been predominantly renewables. From a pure project finance point of view, they're very, very, very limited independent thermal generations coming through, because of the state of the market effect and the spark spread, ultimately. It doesn't make sense. Most of any sort of new build tends to be coming through the utilities, which is corporately funded and not project financed.
I think it also depends a bit where you see the electricity market going in the long term and how much renewables there's going to be in the system. If you look at some of the markets where Germany, for example, leads the way when it comes to renewable share, and you see an increase of negative power prices, you see peak prices disappearing. In Italy, peak prices have come down by 4 to 5 cents. They've been cut in half. In places where, for example, Sweden, where you have a lot of more volatility because of water and how wet is the winter, how much rain do you have. It's a lot more volatile. So the question is, where is the UK going to go in terms of how is its power plant setup going to look in 10 years' time, 15 years' time? I think that's the important question, if traditional thermal will work or not. If you look at the German market, you probably don't want to touch thermal.
Okay. I think looking at the German market, we can learn a little bit in terms of being late mover advantage in solar in Europe. When we look at the Spanish, Italian, some of the Eastern European, but the German market in particular, we can learn some lessons to see what the energy price is doing. I mean, we had a discussion last night about, is it viable to actually have east-west facing solar schemes in the UK? Not yet, but it is an interesting thought. And when we look at Germany in terms of the sort of the peak demand and the peak generation, I think storage is going to be the game changer for us. But in the interim, I think we're seeing some innovative thinkers out there exploring other opportunities until storage comes online in a big way. Any other questions from the floor? If you could sort of identify yourself when you do get the mic.
Ian Beath at Renewable Power. You sort of preempted my question, which is when do you see debt finance for unsubsidised storage being on the radar or coming into play?
That
as
might be
a
question
grid
for
balancing.
Fiery. Yeah, sure. It's a really tough question, and I wish I knew the answer, because you know what? If I knew that answer, I wouldn't be sitting here. I think, though, yes, it will be the game changer. I think the storage piece is the next revolution we face in this industry, and funding that. And obviously, it's going to be a function of the price of power. Recently we've seen that dip in terms of oil, etc. But maybe, I don't know if anybody on the panel in particular wants to comment on that piece.
Not really.
No, we don't have crystal balls in our briefcases. So it's a tough one, and we don't have an answer.
John.
Except that it will change our world. There's a question at the very back of the room there. So while we're waiting for the mic to get to the gentleman in the back of the room, I just have a quick question in terms of ease of transaction. So what I found very attractive in the last 5 years was some of the funds we were doing repeat transactions with was the speed of that transaction and the actual transaction cost as well, as compared to previous deals that we had done on the project finance side. So are you seeing, what are your, in terms of your deals that you are executing in this space, can you give us a feel for the period of time until you have a full data room to look at as to how long it takes you to close a deal and funds start flowing? I guess how long is a piece of string, but I mean, to give us a feel in terms of a well-structured project. Daniel.
I'm happy to go first. Assuming the data room is complete, which it never is, I would say first transaction, 3 months. That can be cut down to 3 to 4 weeks on repeat transactions.
That's pretty quick.
Yeah.
Sue.
And that's possible, but it's a function of how sophisticated the developer is. It's a function of how much he understands what's required for project finance. And what we find is that time is stretched out because you have to sort of hold people's hand and explain to them what is going to be required. Yep. Repeat business means they've actually understood the parameters they have to actually fulfill to get the finance in place. So I think for me, it's experienced developers. Yes, you can move quickly.
I guess there's also a behavioural issue. If the investor accepts that it's a repeat deal, so you don't start negotiating the commercial issues again and again, then it's obviously quick. If you start to open up on that front, it's going to be longer.
Sure. Okay, so nickel and diming it towards the 11th hour is not advisable. It just drags things out. So we had a question at the very back of the room there.
I have it's on. Eisen from Belgium. We are a Belgian EPC contractor active in the UK, but as well in Latin America and Africa. I mean, we see great parity in those areas. We don't see it in the UK, but we see a lot of appetite for investments in the UK for solar. I mean, do you expect any shift from UK funds towards these areas, investing projects in those areas, or the banks maybe looking at potential investments in those areas or financing in those areas?
Daniel, I guess, over
Me?
to you for, in the first instance.
I know that a number of investors that we work with are looking at South America, Latin America. Main issue is foreign exchange risk. I think with a number of countries such as Chile, people will get comfortable quite quickly. And then debt finance is in most places not particularly easy, maybe with the exception of South Africa. I would expect there to be more interest simply because people are looking for yield, but I wouldn't expect there to be a huge wave of interest in the next 2 or 3 years.
So, are you guys doing anything in emerging territories?
Certainly, say up to about 8 years ago, yes, we certainly were. But I think in recent times we've actually pulled back, and given the regulatory issues that we've seen in certain parts of Europe, that hasn't actually really supported us being aggressive in our emerging market mandate.
Yep.
So I think at this time we're sort of like battening down the hatches and trying to actually bring intellectual capital to geographies that we're comfortable with.
Yeah, and I think that's a pattern we've seen with all the European banks through that financial crisis, is they're sort of retrenching into core territories, core markets with core clients. In time, they'll broaden out again. We're looking at bank finance of projects in Latin America as well. It's extremely tough. When sort of Daniel and Sue talk about closing a banking transaction in Europe, it's a matter of a few short months. Those emerging territories, it's a matter of a few short years. It really is tough. So, there is a difficulty there in terms of funding. There are some sort of funds out there that are seeking quite a high yield, and they might put 10% aside to play in these emerging markets. But it is a difficult. It's really about local banks who have a high cost of funds as well. So country risk is a big one. It's a big barrier to these debt financing in these markets. I think we have time for 1 or 2 more questions briefly. So we have one question at the very back of the room.
Hello, John Sturman from Santander. It's a comment really to the developers out there, going back to the last question. The message from myself is to come and talk to the banks much sooner than you are at the moment, particularly when you're looking at procurement. That will help when it comes to financial close timelines. Your procurement strategy and who you use to get your sites to shovel ready is actually quite significantly important.
Thanks for that, John. So yeah, I guess it's engaging early with the banks, and I guess in terms of technology selection, etc. So making your project more bankable, it's good to have that discussion earlier. Just on that, I guess Sue and Daniel, you may feel the same, but then if everybody's encouraged to talk to you earlier, you spend the whole time talking to project developers, projects that don't quite have planning just yet. At what stage is it suitable, at what stage does it make sense for you guys to speak to a project developer who wants to bank his project?
I think realistically speaking, and again this is just a question of resources, I think the point is very well made. In an ideal world, if I had a bigger team, then that sounds great. And I think in the past we have. In fact, when the solar industry was starting to be built up in the UK, we did spend a tremendous amount of time in building that expertise and understanding of what we might, as a bank, might require. But I think that, I'm happy to have quick conversations, but ultimately, I think once planning is in place, I think really is where I am.
Okay.
Yeah.
It depends a bit on the client, I would say. For core clients, there's generally a relatively frequent update on pipeline visibility, so There's a view of coordinating resources. Also, we need to have resources available when things get planning and need to get going. Earlier projects, I think that the comment is aimed at unilateral finance and ECA finance. Yes, that's true, but then those are normally large tickets where we would only do it with core clients anyway, so we would have the visibility normally as a normal course of business.
Okay. So, Mark, do you want to have one last comment on that? Because I'm aware of time now, so we're going to wrap up. I don't think we've time to field any more questions at this time, but do you want to have the last word?
I'll have the last word, which is unusual, but I just wanted to go back to one point, which is just about the sort of, there's a question here about timing of engagement, timing of doing things, and that links back to what we've been talking about portfolio, because there are many players in the market now who are getting very large portfolios. Is there an advantage to having a portfolio in terms of speed of execution? From a legal perspective, not really. There might be a little bit. But unless you're a rooftop developer with 25,000 different sites, where there might be some kind of efficiency on portfolio basis, if you're just talking about standard large-scale wind farm projects, solar farm projects, sorry, then there isn't any particular advantage to that. There's a question of familiarity, but the cost and to a large extent timing is going to be the same. So my message would be you still need to try to allow the same amount of time for everything, really.
So I think in summary, the debt piece, it's very much there. The banks are out there doing business. I think the quantum levels have come down a little. I think certainly the pricing terms have improved, but they have more competition than they ever had before. There's lots of new funding sources, both debt products and equity out there in the market. So it's a very interesting space to be. Although currently in the UK, we have a very narrow window of opportunity, I guess. So any new entrants into the market, good luck with that. Any existing entrants, you're probably, at breakneck speed trying to get done what you can do. I think it's a very interesting space to be in at the moment. So on that note, I'd just like to thank the panellists, Mark, Sue from Royal Bank of Scotland, and Daniel from HSA. Thanks very much.